Ladies and gentlemen, good day and welcome to the Man Industries Q3 FY'24 and 9 months FY'24 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this call is being recorded. I now hand the conference over to Mr. Kripashankar Maurya from Choice Equity Broking. Thank you and over to you, sir.
Thank you, Manuja. Good afternoon, everyone. On behalf of Choice Equity Broking, welcome to Q3 9-month FY'24 post-conference call of Man Industry. I also take this opportunity to welcome the senior management team. On today's call, we have with us Dr. Ramesh Mansukhani, Chairman, Mr. Nikhil Mansukhani, Managing Director, Mr. Ashok Gupta, Chief Financial Officer, and Mr. Rahul Rawat, Company Secretary. Kindly refer to the safe harbor statement on the second last slide of the earnings presentation. I will now invite the management for their opening remarks to be followed by the question and answer session. Thank you and over to you, sir.
Let me begin by giving you a brief of the financial performance for the quarter. Our total revenue stood at 847 crores, representing a growth of 26% year-on-year. Our EBITDA stood at 79 crores, with the EBITDA margins reported at 9.49%, and the net profit stood at 30.6 crores. Coming to our financial performance 9-month FY'24, we reported a total revenue of 2,300 crores and 69, which increased about 43% year-on-year. Our EBITDA stood at 221 crores and the EBITDA margin of 9.5%. And we reported a net profit of 81 crores, representing a growth of about 92% year-on-year. On the operational front, the unexecuted order book as on date stands at around 1,300 crores to be executed in the next 6 months. We continue to have outstanding bids for more than 11,000 crores at various stages of evaluation for several oil, gas, water projects in India and abroad, which sets our expectancy for good order inflows in the next few months. Currently, some of the orders we are at a good, strong L1 position. Maintaining sound financial health, our debt-equity ratio is 0.14% and currently hold a net cash position in the company. Coming at the outlook of 24-25, our top line will grow at approximately 20-25%, which would be approximately around 3,600 crores, and the similar growth of 30-35% on the bottom line. EBITDA will stand at approximately 9-11%, and which would contribute to around 350 to 360 crores. For 25-26, our top line will grow around 60 to 70% from year on, which would be approximately 5,000 crores, and the EBITDA would stand at approximately 10 to 11% to around 500 crores. Recently, we've achieved a significant milestone in the industry by successfully testing a hydrogen transportation line pipe, setting a benchmark as we are the first one in the industry to do so. Looking ahead, we are confident taking the first mover's advantage, enhancing our capability and book for the new hydrogen line pipes. The world increasingly recognizes hydrogen's pivotal role in decarbonizing industries and establishing a clean energy. Man Industry addresses this with its pipes having passed the fracture toughness for hydrogen service test, ensuring structural integrity and safety for hydrogen transport. This certification safeguards us against challenges related to hydrogen's small molecule size pertaining material more easily other than the other gases. In India, the Ministry of New and Renewable Energy has set ambitious targets for energy independence by 2047 and net zero carbon by 2070, underscoring the importance of green hydrogen in achieving these milestones. The breakthrough reaffirms Man Industry's commitment to driving positive change in the energy landscape and marks a giant leap towards a sustainable and hydrogen-powered future. For our ERW plant, we received all the accreditations recently, and the revenue has just started flowing in. And the major revenue which will flow in from 24-25, and the company has also received for some of the orders. The company Q3 results is impacted also due to certain delay in approvals of ERW, and due to the depreciation and finance costs of the ERW. We are also expanding our geographical presence through our subsidiary companies by setting a new plant in Jammu for stainless steel pipes. The capacity is around 20,000 tons, and which is expected production in Q4 of 2025. Total investment capex outlay is around 550 crores, and post the abrogation of 370 in J&K, the government has planned to increase economic activities to set up the new units. The state government is also providing various subsidies and a large incentive on total capex outlay on plant and machineries through SGST and CGST credit over 10 years, and faster land allotment approval in Jammu Industrial Belt. Moving on to our bending plant, which was started last year. We've already got 3 orders internationally, and which is already under execution, and we are booked for the next 3 to 4 months. In our subsidiary company, Marino Shelters, we are in process of finalizing a joint development agreement with a reputed developer, by which we will get 40 to 50 crores by this financial year end. And in the long-term revenue in the next 4 to 5 years, we will get a large chunk of revenue, which will be coming in the next 4 to 5 years. The company has decided to raise funds up to 250 crores by the way of issue of one or more instruments, including equity shares, convertible or non-convertible securities of any description of warrants or debt securities, through preferential issue, qualified institution placements, right issue, or any other methods or combination, subject to such regulatory statutory approvals as may be required, including the approval of shareholders of the company. The funds generated will support the company's strategic initiatives and expansion plans, ensuring the company's future commitment. With that, I conclude my opening statement, and we can now open the floor for the question and answer session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Kaushik Jawar, AKJ Capital. Please go ahead.
Yeah, thanks for the opportunity. Great set of numbers on the team. Sir, I have a question on the stainless steel business. So, please correct me if my understanding is wrong. So, we will be outlaying the capacity of 25,000 tons there, and the place has been decided as Jammu and Kashmir. And I wanted to understand, this plant will be operational in FY'26, because aren't we a late entrant here, because already the similar capacities have been running in other companies also. We follow those sector companies. So how much time it will take the order book, because it takes time, right, to scale up that stainless steel business. But you're saying on the operational first year, you would expect somewhere around, if you do the math, some 500 to 1,000 crores of revenue from the first year. So is that the expectation, and how does this cycle work? Can you explain on the order book, etc., on the stainless steel part?
Yeah, good afternoon, Mr. Dawar. So from the stainless steel, the operational is Q4 24-25, and this is for commercial production. And as per the business plan which we have taken in context right now, the first year we've taken a top line of between 400 to 500 crores. This is mainly the mother pipe, and part of it will be the pillar product which will go into the market. And as per the other the players, obviously Ratnamani is already there, and there is Sandvik and few more players. And as per the business plan and the market scenario, there is quite a big demand on the product currently. And due to the BIS and the restriction put in to import the mother pipe from China, the current demand is quite high, and the local people, such as the other vendors, are not giving the mother pipe. They are actually pilgering it and giving it for the projects. So there is a good demand currently, and that's what we envisage when we are putting this project.
Okay, so we will be catering to the domestic market here?
Yes, we would be initially catering to the domestic market and also the export market.
Okay, so it will be in the oil and gas sector only?
Yes.
Okay, so it will be a mother pipes, this is our product.
Percentage of ratio will vary. The first year we will do probably 60 to 70% of mother pipes and only 30% pilger. And as the accreditations and everything, as you start exporting and get approvals worldwide, we would change the balance accordingly. And also we are capable to do higher inconels of duplex, super duplex titanium from this mill. So, once the stabilization happens initially, then we will also convert it to a higher margin product as well. Okay.
The other part, what you said, 30%, I did not understand that part. Mother and the other one, what was that? Can you explain that?
Sure, pilger. So they are basically, they are high value products in the sense they are smaller diameter. So a press can remove a certain size of a mother pipe and then you pilger it down for different usages, such as you have for aviation and then you have for nuclear. So there is a certain size which the press cannot make, which will get pilgered and then goes, which is a higher margin business also.
Okay. What would be the margin for the shallow mother pipe?
So the total margin for the SS seamless tubes is between 18 to 22%. So anything between 10 to 11% for the mother pipe and 10 to 11% for the pilgering bit.
Okay. And what is the series we are focusing on? Series 3, 4, what?
So we have 3-1 series in the sense the product quality you mean, or which one? Grade.
Yeah. Grade.
316 is the principal, 316 and 316L. And then so on for the 304, which is one grade lower. And then you have the higher inconels, the super duplex and super duplex alloys.
The next question is from the line of Ritesh Gandhi from Discovery Capital. Please go ahead.
Hi, sir. Just as a question, given we are already almost debt free and we've already issued, warrants to the promoter and the healthy EBITDA that we have guided to for both FY'25 and FY'26. Just wanted to understand the rationale for raising incremental 250 crores.
Hi, Dinesh. How are you? So, Dinesh, the reason for the incremental is that currently we are doing a capex, which is outlay of the capex is 550 crores for the SS. And then also we have certain capex in the pipeline. We are just waiting for certain permissions for our expansion of ESO in a different country. So we are already looking at that, and on the basis of that, our capex level will be between the debt levels will go up approximately to around 600 to 700 crores. And to balance between the debt and cash in the company, we are just keeping some incremental value in the company.
Got it. Understood, sir. Sir, the other question was with regards to the approval you have on the hydrogen side, which you've spoken about. Can you explain as to how difficult this approval actually is to get? Who are the other people who are looking for it, and how does it place us in terms of this space and when do we expect actually the revenue to come from here?
So, like I said, hydrogen is a new sector. It took us 16 months to get the approval from the European research lab. It was quite a detailed survey on the pipes and the fracture process, that under a certain pressure there should not be any leakage and fracture during the once the pipeline is laid, and the hydrogen, because hydrogen is quite a notorious gas. It was a 3-step process which the lab had done, and the final process approval certification we got just a few months ago. And looking at the outlook, India is looking for hydrogen and clean energy to go. I think 2050 is the vision for India, but Europe's vision is 2030, 2035. So there are a lot of orders in which now we are already bidding, in which they're hydrogen enabled. So basically the designing is done in such a way that the steel and the quality which is used is for the hydrogen. But currently they're not using hydrogen gas, but they are enabling the pipeline so that you can be used in the future. Also future, the hydrogen thing is very important, that every single line pipe of hydrogen has to be laid down new, because the old lines do not work for the hydrogen. So it is a brand new sector for us. So I cannot tell you exactly how much business will come, but it's a brand new sector, like how a gas sector is there today. It's a brand new sector. And tentatively what in the Vibrant Gujarat also, which was announced, approximate quantity in the next 10 to 15 years is probably more than 5 million tons, out of which I think certain bit is committed by the Adani and certain bit for the new SR is putting a new hydrogen in Gujarat. So the sector looks very positive going forward, and I think the orders will come from the next 3 years onwards.
Got it. That's extremely helpful. That's all from me. I'll rejoin the queue. Thank you.
Thank you, Dinesh.
Thank you. The next question is from the line of Samman from Tiger Asset. Please go ahead.
Yeah, hi, sir. Thank you for the opportunity. So the first question is, like, I joined the queue mid late. So for FY'26, what is the revenue and margin guidance for you, sir?
So FY'26, we are looking at a top line of approximately 5,000 crores and the EBITDA level at between 10 to 11%, which would be around 500 to 550 crores.
Okay, great. Thank you, sir. So my second question is on, like in last Concall, you said like we were expecting payment in 1 month for Merino shelter, and like today you said like still in process and we are like expecting by FY'24. I mean, why was there a delay?
No, so the basic thing is we are going to get the payment in this couple of months. That's why I said before the end of this year, we will get the certain amount of payment. The delay was because there was a legal due diligence which was going on, which has got completed now. So the final documentation is in process, and once that is done, only we can, give declare the entire thing and give the details out. So it has to be more.
What is the quantum of payment we are expecting?
So we should get around 40 to 50 crores this year, and then once the transaction is completed and the entire details are out, then I can disclose further details of it. But a large chunk of revenue will come to the company for the next 4 to 5 years.
Right. Also, sir, on the margin front, like in this quarter, like there's a bit confusion between operating and other operating income. Like if we explore that, it will come around 7.5%. Right? Like, can you tell us the nature of other operating income that you mentioned in the?
So actually, it is income through operational source only. The foreign exchange benefits which we get through this business, and sometimes the cash flow when we have extra cash flow and it is going in FD and everything. These are the only revenue which is generated from other expenses. So and sometimes even the export incentive which is there when we buy locally and export, so we get that also. So that is what goes in the other expense. So that is why we always nowadays add it and put it together, that it is other income from operations.
Right. Thank you. So final question is on like this CapEx that we're doing. So you said like we are developing 2 products. One is mother pipe, and can you name the other product?
So it's basically mother pipe, and through the mother pipe you draw it down or pilger it down and make a pilgered product, which is goes in, like I said, nuclear, pharmaceuticals, and different sizes, because the mother pipe main machine of the extrusion press does not manufacture to that size. So one is a hot drawn process, extruded process, and one is a cold drawn process after the hot drawn process is completed. So that is why this is the 2-layer process.
And with these products, we are planning to venture into aviation and nuclear sector?
Yeah. This product is used from aviation, nuclear, pharmaceuticals, fertilizers, heat treatment, everywhere. Dairy.
And so any particular discussion with any potential clients in this regard?
Sorry, I didn't get that.
Any particular discussion with the potential client for this product?
It's in progress. We will be participating in one of the tubes fairs, so we keep meeting, so we are discussing continuously. But then I think it will only materialize once the plant is operational and in execution that time.
Sure, sir. Thank you and all the best.
Thank you. Thank you so much.
Thank you. The next question is from the line of Vatsal Kothari from Alf Accurate Advisors Private Limited. Please go ahead.
Hello. Hi. So I have a couple of questions. The first question is that I would just like to get some clarification on the EBITDA guidance for FY'25 and FY'26. Are the EBITDA numbers you mentioned including other income or excluding other income?
So hi, Vatsal. So the EBITDA would be around between 9 to 11% for 24-25 and 10 to 12% for 25-26. The EBITDA is including other income because the income is generated from this particular company itself. It is not generated from another source or outside source. One kind of business.
Understood. Just wanted to understand that excluding other income, what would the EBITDA margins look like for 25 and 26?
I think more or less if we see as an average 2%, 1.5-2% difference. Almost 1.5% as an average when we put it. It's almost that much only.
Understood. And, my second question is, how would the order book breakup for the current quarter look like between the oil and gas segment and the water segment? And, expanding on that, what would the EBITDA per ton look like for both these segments respectively?
So the order book currently stands at 1,300 crores and it's currently 50-50%. It's oil and gas and water also 50%. And going forward, we are L1 in a few bids which are for oil and gas. The EBITDA margins normally for oil and gas comes around, between 11 to 13%, and for water comes between 7 to 8%. So at a blended rate, it would land up between 9 to 11% year on year. And we are working on some operational activities to increase the EBITDA at least by 1%.
Understood. And what would this breakup look like for 1 year before in Q3 and Q3?
1 year before it was, I think, the 70-30. I think more 70% was oil, gas, and 30% was water.
And for Q4, would it be reasonable to expect the same numbers, 50-50 breakup?
Yes, it would be.
Understood. Perfect. Thank you so much.
Vatsal, adding to his point, see, in our other income, we do consider, foreign exchange gains. Since we are generating these foreign exchange gains out of our core business, we are considering it as our other operating income indeed. But it is classified under other income according to ICAI guidelines.
Perfect. Thank you so much. Thank you.
Thank you.
Thank you. The next question is from the line of Anirudh Agarwal from ValueQuest Investment Advisors. Please go ahead.
Yeah, thanks for the opportunity. So, Nikhil, first question was on your plant. So, if you could just share some more details on that.
We can't hear you, Anirudh.
Is it better now?
Yeah, slightly better.
Yeah, I was just saying if you could share some more details about the Saudi plant plans. I think you had mentioned in one of your interviews and, you alluded to a new plant in another geography. If you can just expand a little bit on that.
Anirudh, for the Saudi, we are just still waiting some in-principle approval. So we cannot really discuss any of the numbers and we cannot declare it till the time it is signed off and clear. Once that is done, we can give you all the details and everything. We have the workings and everything, but I cannot, obviously for reasons, I cannot disclose it right now here.
Understood. But safe to say it would be like buyout of an existing plant or something, I'm assuming, which you would want to hit the ground running, right? And not a new infield that will take 3-4 more years. Is that broadly correct?
Comment on this right now. It would not be correct of me to do that.
Understood. Understood. Second, on real estate, if you could just mention, I think you mentioned something on revenue share going ahead. So, that is basically some sort of JV that we enter with,
We can't hear you. Your voice is not coming properly.
Hello, is it better?
Yes, is it?
Yeah, thanks. Sorry. So I was just saying on the real estate deal, the correct understanding is that basically this is a JV that you would be looking to enter, right? As and when the deal finalizes, and that is why you would see some revenue share over the next 5 years.
Yeah. So it's a JDA. It's a joint development agreement with A+ grade developer from Mumbai. And they will develop the entire project, and they will give us obviously upfront revenue and as well as revenue throughout the next 4 to 5 years of the project.
Got it. No incremental financial investment from our side required, right? This is only the land that, basically...
No, nothing. Only we are supposed to receive only now. We are not putting any more money.
Okay, great. Got it. Third thing was on new orders. So basically, I think historically, like you also mentioned, 70 to 80% used to be oil and gas, and water we used to typically avoid or, take lower contracts of. Is there something on oil and gas that is, leading to pressure in terms of new orders for us? Can you just throw some light on that?
No, I didn't understand your question.
So typically, I was saying oil and gas, we used to focus on largely oil and gas orders, right? So over the last few months, basically, we've seen that new order wins have been slightly slower than, the rate we would have expected and what we are seeing for some of your peers. And even within that, it seems like there are larger water segment orders. So anything on oil and gas that, is not worked for us or any challenges?
Yes. So basically the water is contributing to a good portion now is because of the drive in India for the water. The oil and gas, like I said, it is ongoing. Couple of years, there's some sort of slowdown, then something else picks up. So we are looking at a big upscale in the oil and gas in the coming years. Plus also ONGC, deep sea exploration they have done now. So that is also demand. A lot of demand is coming from there. And as well as the ERW, there is a capex planned by the government for 18,000 crores for city gas furthermore. So looking at the future demands, the last year though we were also more focused on exports because there were good size export orders. Going forward, we are seeing good amount of demand in oil and gas also, India and abroad. And water will continue to obviously drive up the revenues also. Water is equally important for us.
Got it. And oil and gas export orders, the right way to understand is you would need some local manufacturing presence to, garner larger orders, right? And India plant itself is not sufficient to do that.
No, not really. It depends. Some countries have a restriction of a percentage or something, but rest of the countries where it's an open tender, there is no restriction. So we make it from India only, and we are more than sufficient to make from here.
Understood. Okay, got it. Thanks a lot. That's it from me.
Thank you. The next question is from the line of Khadija Mantri from Capri Global. Please go ahead.
Yeah. Good evening, sir. My question is regarding the numbers. So was there any one-off in the other expenses? Because we can see it as...
We can't hear you. Your voice is coming very low. Can you speak up, please?
Hello. Yeah, is it better now?
Yeah, it's much better.
Yeah, sir, so my question is regarding increase in other expenses. Was there any one-off in other expenses? Because as we can see, there is a sharp increase.
So majorly, the freight charges have gone up because we had an export order. So the major cost on the other expenses is the freight.
So can you quantify that?
From the corresponding quarter of December 22, that was overseas freight was around 25 crores. BC for the current quarter it is 70 crores.
70. And so my another question is regarding gross profit margin. So do you have any guidance for gross profit? Because we can see it has increased by 300 basis points in this quarter. So what would be your guidance on a sustainable basis? Hello? Hello?
So basically, like we said, the EBITDA margins. Can you hear us? Hello?
Yes, sure, yeah.
Okay, so the EBITDA margin levels will be around 9 to 11%, like we guided.
Okay, sir. No, my question was regarding gross profit margin.
Profit margins are also similar level only, which has been in the company for the last 3 years.
Okay, sir. And sir, bit of a long-term question. Do we see any opportunity in the coal gasification project that the government is taking up?
For any gas or transportation line, the cheapest form is obviously to put it by a line pipe. So as we are already approved in all the government authorities, definitely we'll be looking at it if anything comes up.
Okay, sir. Thank you. That's all from my side.
So, hi, Kamal this side. Our gross margin is always around 18 to 24%. Since our OPEX is getting increasing because of our ERW expenses and other expansion plans, that's why we are looking at the EBITDA margin at 9 to 11%, which is sustainable. Gross margin, if you will tell, our gross margin is standing around 18 to 24% every quarter.
Okay, sir. Sure. Thanks.
Thank you. Before we take the next question, a reminder to all the participants that you may press star and 1 to ask a question. Thank you. The next question is from the line of Ruchika Dhanuka from Phillip Capital. Please go ahead.
Good evening, sir. Thank you for the opportunity. Just wanted to know if you could help us with the volume numbers for the quarter. Hello, am I audible?
Yeah, Ruchika. So it's approximately 85 to 90,000 tons.
Okay. And similar number for the same quarter last year, if you could.
It's same quarter last year would be slightly similar. I think around 65,000 tons last year. But the steel price was higher, so you cannot match it directly proportionate to top line.
Sure, sir. Okay. And so what is the capex number for FY'24 and 25?
The capex number for 25 is around 150 crores, and 4 was around 90 crores.
90 crores. So what would be the unspent amount currently for this year?
Around 25 crores, which we are spending now in the next 2 months, 25-30 crores.
Okay. Sure, sir. Thank you so much. That's it from my end.
Thank you. The next question is from the line of Nikhil Chaudhary from Investor. Please go ahead.
Hello.
Hi, Nikhil.
Go ahead.
Yeah, hi. Sir, wanted to probably understand our visibility with respect to the hydrogen pipes. You did mention there is an opportunity in Europe, but are there any active probably orders that we expect in probably coming quarters, or is it a still far-fetched thing that might come in probably next 2 to 3 years only?
So we have bid certain orders in Europe, but it's in the pipeline. It's basically an hydrogen-enabled line, so I don't know whether they will run it, but it is designed as for hydrogen. So it will be very good for us also if we could, win that order. And other than that, India we are looking at it, but it would take 2 to 3 years. I think everyone's working on it. And like I said, once it comes up full-fledgedly and couple of lines are laid down and everyone gets the confidence, then it's all new lines of a brand new sector, like how we have water, gas and oil. Hydrogen will be a brand new sector, which would drive a lot of the natural energy up.
So Nikhil, adding to this point, the hydrogen pipeline market is projected to grow from $9.1 billion US in 2023 to $26 billion by 2030. So the CAGR would be around 16% year on till 2030. And you have to look it from a global angle, not from India angle. So we are open for every market. So demand is high. As he rightly said, all the lines would be virgin. So there is a huge demand in this sector. And being a front mover, we will take that advantage.
Okay. Also, probably any margins that probably might be envisaging in probably this new thing that we are doing?
Margin would also be higher than our regular saw pipes, but we have not done any such products, so it will be very difficult to quantify that. But we do expect the margin would be somewhere around 18 to 20% at least.
Got it. Got it. Also, wanted to understand with respect to our this seamless expansion that we are doing, what would be the risk to our commencing of operations by, let's say, Q4 of 25? Anything that probably you feel will delay the CapEx, any land acquisition which is pending on our cards, something that worries you, or that should worry us as also an investor?
No, not really. We have already placed all the long lead items, already has been placed, and all the LCs and the finance has been opened up already. So we do not see. Definitely, the only challenge will be to get it executed properly and on time, which we anyways have the team and specialty to do the needful. So other than probably, few months plus and minus, I do not envisage any other issue than that.
Got it. Interesting, sir. Thank you so much. I'll come back in the queue.
Thank you.
Thank you. The next question is from the line of Vignesh Iyer from Sequent Investments.
Yeah.
Please go ahead.
Thank you for the opportunity, sir. Coming on the CapEx part of your business, so we are expected to do 550 crores for the stainless pipe, right? And as I can see, the CWIP stands at 50 crores now. So just to get your understanding, will you be spending the 500 crores in remaining part of the FY'24 and 25, right?
Yes.
No, because since you guided for 150 crores of CapEx in 25, so I couldn't add up the amount.
No. So the debt, 550 isn't, I'm talking about the internal capital utilization. The rest is from the bank debt, which is taken. So,
okay.
Yeah, so more than 170 to 200 crores has already been, including LC's opening and everything. Approximate expense of the SS, which has been done till date, is 124 plus 70, around 190 to 200 crores. So for this year, till December, the further CapEx would be approximately 300 to 350 crores to complete and start the project.
Okay. And since so you are anyways raising around 250 crores, for in equity, still you're guiding for a debt of 700 crores. So I'm thinking, what is that additional amount coming for?
So we have planned certain expansion abroad, in which we are just waiting for the final approval. Once that is done, we would be moving there as well. And for that reason only, we are raising the funds. And we don't want to stress out the current cash and existing business running. So that's the reason for raising the fund.
At what rate are we raising this debt? What is the expected cost of fund?
No, we are not raising it through this particular. We are talking about 250 crores is through a preferential allotment. Up to.
No. I'm talking about the debt that will be raising over and above this to fund the plan.
0.5%, 9 to 9.5%, and when it's US dollar, it's around 7.5%.
Okay. So coming to the part of other income, so we have, if we go through a lot of companies that are posting their quarterly or half-yearly financial statements, right? They do insert a column called other operating income in the financial statement itself, and approved by the Ind AS as well as Companies Act. right? I mean, that gives you a better picture of what EBITDA is, because Orange, we have to wait till the investor presentation is out to understand what is the actual EBITDA margins, right? So I would request you if that new line can be added where it is shown as other operating income and we have an other income column separately for it.
Yeah, we'll do that. Yeah. Thank you for your suggestion. We'll do that.
Yeah. Thank you, sir. Yeah, I'll get ready.
Thank you, Vignesh.
Thank you. The next question is from the line of Dhananjay Mishra from Sunidhi Securities. Please go ahead.
Yeah, hello, sir. So in your guidance of 3,600 crore for FY'25, so how much contribution you have considered from ERW? And for FY'26, because we are saying that stainless tube will be contributing close to 500 crore in the first year. So are we considering some other incremental revenue coming from unplanned capex in FY'26 revenue? Because can you just clarify on that?
Yes, sir. So from this year, we are contributing to ERW is around 300 to 400 crores for the 24-25, and 25-26 we are looking at around 500 crores from 400 to 500 crores from it. 700 to 800 crores from the existing ERW, which will be fully in track. And plus certain capex, like we said, we are going to one of the Middle East countries, and we are just waiting. We will be getting certain revenue, but a small revenue. That's why we have kept it at around 5,000 crores of a top line, which is on the conservative, approachable side, of 10 to 11% for 26.
Because ERW, this 115,000 capacity, as last time I think you said that peak revenue could be around 400 crore. Now we are saying that it could be further increased to 700 crore.
No. ERW peak revenue can go up to almost 1,000 crores. And we are considering for this year, as this is because we just got all the accreditations now. So the first year we are considering around 40% of 40 to 50% of the top line from their capability top line to 30 to 40%. And stainless steel for the first year we've considered between 30 to 40% again.
So this 1,000 crore
will really ramp up.
So 1,000 crore top line you are considering at what volume? 1 lakh this volume? 1 lakh ton or
1,50,000?
वॉल्यूम के ऊपर वैसे नहीं हो सकता है ना, वो मार्केट के ऊपर ड्रिवन है. अगर स्टील प्राइस अगर 70 रुपए है तो उसके ऊपर जो मार्जिन ERW का रहता है उसके बेसिस पे होता है. So that I cannot comment 1 year down the line what will be the current price. The volume, what we are saying is that if 100,000 to 125,000 is the capacity, we are looking at anything between 30 to 40% usage of that capacity, which will culminate to around 300 to 400 crores for 24-25, and almost 700 crores for 25-26 from ERW itself. And SS26, the first year, would be around between 300 to 400 crores.
Okay. Thank you.
Yeah.
Thank you. The next question is from the line of Manan Shah from Moneybee Investment Advisors. Please go ahead.
Yeah, hi. Thanks for the opportunity. I wanted to understand on the hydrogen pipe segment that we plan to enter. So, how are these pipes different from the pipes which are getting used for the existing natural gas pipeline? I mean, why can't those pipes be used for transporting natural gas, hydrogen?
So, basically the grade of steel is completely different. These grade of steels are used for sour gas. So, the formation, the process, what we do is the same, but the grade of steel and the welding is different. So these are used for highly sour grades of crude and gas. These kind of grades of sour grade steel has been used, and these are the same grade which we tested through our pipes for hydrogen, which got qualified. So that's why they have to lay down the whole new lines, each and every new line required for hydrogen.
Okay, understood. What would be the competitive landscape for these kind of pipes currently?
For the hydrogen pipes?
Yes.
Basically, once the approval is there with the authorities, it's the first mover's advantage and how you get your approvals in place, which is a very big process in our industry. Once you are through with that, then I think it will be a good, but India will be still competitive to the world. We've seen that. And qualification is very, very important.
To ask, when you're bidding, generally, how many players are there who are bidding for this versus, say, when you're bidding for an oil and gas order? So, there are just 2 players or 3 players who are bidding for the same order, or there are...
It will be far lesser because this is only used in LSAW, not in spiral. So, firstly, all the mills who are only making LSAW pipes will be qualified for hydrogen, number one. So a large quantity of 70% of the quantity of the world of spiral quantities go out. So you have reduced the number to quite a small amount. And out of that also who are qualified and capable and have the credibility and have a past experience of sour grade will get the further experience, and also having a steel tie-up and good relationship with steel mills, because this kind of steel currently which is approved for hydrogen is only 5-6 mills in the world.
Okay. And for us, this will be the raw material, the grade of steel required will be domestically sourced, or we have to import it?
No, it's all imported. Domestically, it's not available.
Okay, understood. Oh, and are there any current live tenders for this project, for hydrogen pipes?
Yeah, we've bid for a couple of them in Europe.
And what would be the size of these tenders?
Decently large size.
Okay, understood. Sure, thanks. I'll get back in the queue.
Thank you.
Thank you. The next question is from the line of Samfman from Tiger Asset. Please go ahead.
Yeah, hi, sir. In this quarter, you said there's a pipe cost increase from 25 CR to 70 CR, right?
Yeah, please.
Yeah, there's an increase in freight cost in this quarter from 25 CR to 70 CR. Hello?
Yeah, because for the corresponding quarter of December 22, this composition of order from the domestic market. And currently at the quarter is basically on exports. The sea freight is more on account of sea freight.
Okay, so where I'm coming from, is there an impact of Red Sea prices to us or to our business?
So no, these are regular expenses of shipping. It's not any increase as such because of the Red Sea issue or anything right now.
Nothing is.
Okay.
Thank you. The next question is from the line of Dheya from Nivesha Investment Advisor. Please go ahead.
Thank you for the opportunity, sir. I just wanted to understand that the Red Sea issue has not been accounted in this quarter's results, right? So how much pressure do we expect, if any, in the current quarter?
No, nothing as such. The contracts were pre-signed and there has not been any changes from that front. And so we are not envisaging any price impact or anything due to the Red Sea.
So, as I understand this, going forward, if the issue continues, then we might face the pressure, right? The freight pressure.
It's not that. We always accommodate that in our cost. So whenever we take the cost as per the logistics software, and the future also cost can be seen in that. If right now, because the Red Sea issue is already flared up, so it is already catching higher costs. So when we are bidding for the projects, we are already catching a higher cost for the logistics. In case it might turn out, if it cools down and we have taken a higher cost, we might get an advantage at a later stage. So currently, we are not at any loss.
Correct, sir. That was helpful. Also, you told that our order book is split into 50% oil and gas, and 50% water. So, seeing that there is an immense demand, as you told, in the oil and gas sector, are we seeing that any, so are we seeing incremental percentage of oil and gas segment in the order book?
No, so we average when we say it's around 70%. Current quarter, like you said, going forward quarter was 50%, and this quarter, but normally it is 70-30%.
So are you looking at 70?
Also, we are seeing the same kind of outlook.
Okay, correct. Also, I had this last question on the China competitiveness. As you know that China is, coming back into the global markets now. Are we seeing any competitiveness from Chinese players in the tenders which we bid for in the international market?
Not really. Maybe some tenders in Africa, but rest of the places, they are only part of the AVL in the steel supply. They are not in the part of the approved vendor list and the pipe supply. So, which is a big advantage for us.
Okay, that's really helpful. Thanks a lot, sir.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up questions, we will request you to rejoin the queue. Thank you. The next question is from the line of Manan Shah from Moneybee Investment Advisors. Please go ahead.
Hello. Yeah. Hi. Thanks for the follow-up. I wanted to ask, you mentioned that we are expecting some approval from the Middle East. So, wanted to understand if the fundraise is contingent on that approval or we would be still going ahead with that.
No. We are going ahead. This is in principle, as in this is an approval which is not, it's a process, that's about it. It is not something which is like I have to take it from someone else. It's basically just a process based, and it is not contingent as per that.
Okay. Understood. Thanks.
Thank you. The next question is from the line of Kaushal KD from Wallfort. Please go ahead.
Yeah. Hi, sir. So I just wanted to understand, earlier in the call you mentioned that some freight costs have gone up to 70 crores vis-a-vis 25 crores last quarter or last year?
Corresponding quarter of last year, December 22 I was talking about.
Okay. And so haven't across industries freight costs come down compared to last year? I mean, I think you are an exception where the freight costs. So can you just give a little more detail about this?
It has not gone up. Freight cost is down only, but it is the size of the project which got shipped out, because last year, like we said, this year, almost 70 to 80% was export order, couple of large export orders which we did. It's on the basis of that. So the domestic, obviously, logistic cost went down and the shipping cost went down.
So this is not a one-off cost, it's a regular cost which will be incurred going forward also for export orders.
Regular cost. If nothing, we might have saved some freight from the regular cost.
No, come again, sorry.
If not, we would have saved the freight when the freights were down rather than spend more cost on the freight. So that's what I'm saying.
No, I'm not clear, sir. Sorry, I'm sorry. So you're saying that in any case of export?
Freight cost, we did not spend more on the freight cost. We were in line with the freight cost of the market, or we were actually lesser because the market was down at that time. So we negotiated well. So we would be probably lesser, not more.
Okay, so this is more to do because the export volumes are up. That's why the freight cost is seeming to be more. Okay, understood. Okay. Thank you, sir. Thank you.
Thank you. The last question is from the line of Vinay Rokadia, an individual investor. Please go ahead.
Yeah, thanks for the opportunity. Just I wanted to know what are the basic raw material and what was the price movement in this quarter regarding, because was it stable or something that sort?
So basic raw material is still HR plates and HR coils. It is specially basically for API grade. We procure it from domestic market as well as we get it imported from countries like China, Korea, Japan, Germany.
And what was the pricing trend in the raw material? Was it stable or something?
It is more or less stable.
Okay. Okay. And just last one question, sir. Regarding this Marino shelter, can you just brief something about the size of the project or what will be our share or something and the area in which this project is coming up or something like that?
विनय जी, मैं अगर अभी ये बता दूंगा तो ठीक नहीं रहेगा. I cannot disclose it till the time it is signed off, but it's a large size of project. That's what I can say. It's approximately between 20 to 25 lakh square foot of area which will be developed, and we will get a good chunk of share for our revenue. And these revenues, like I said, would continue to come in for the next 4 to 5 years. And the company, whatever company is invested, hopefully company will get 3 times of that amount.
Okay. Thanks a lot, sir.
As there are no further questions, I will now like to hand the conference over to management for closing comments.
Thank you. Thank you all for participating in the earnings phone call. I hope we were able to answer your questions satisfactorily and at the same time offering insight into our business. If you have any further questions or would like to know more about the company, please reach out to our investor relations manager at Valorem Advisors. Thank you. Stay safe and stay healthy.
On behalf of Choice Equity Broking, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.